Now we're going to look at gearing. Now this is a very simple definition of gearing. As always, the gearing calculation is going to be defined in the project loan documentation. So once again, your credit agreement or your facilities agreement, they will contain the definition of gearing for the project. Gearing is usually defined, and like I said, this is a simple definition, as debt divided by debt plus equity. So in this example, it says debt is $15, equity is $5. What is the gearing? Okay, so the gearing is simply going to be your $15 divided by the aggregate of debt plus equity. So in this case, it's going to be 15 divided by 20, which is 75% gearing. Now, just a note on gearing, a lot of these project finance deals have instruments such as sub-debt, shareholder loans, etc., and usually these subordinated pieces of debt or shareholder loans are equity instruments, i.e. they're usually injected by the project sponsors or shareholders as such. And one of the reasons this is done is because the distributions from these instruments is not subject to accounting restrictions. And we'll talk a bit about this later, but usually what happens, and it depends on the jurisdiction, but if you don't have a positive retained earnings, you can't distribute dividends. Okay? So that's gearing. Let's look at debt service coverage ratio. Okay, so the usual definition of a debt service coverage ratio is CFADS, or is simply CFADS, so cash flow available for debt service that we looked at before, divided by your debt service. Okay, so an example of the debt service coverage ratio calculation is below. So in period 1, we have CFADS equals $30. We also have a debt interest payment of $15 and a debt principal of $5. Okay, so our total debt service is 5 plus 15, which is going to be 20. Now, going back to our debt service coverage ratio, CFADS divided by debt service, so we've got 30 divided by 20, we get a debt service coverage ratio of 1.5. And that's just for that period. So what usually happens with a debt service coverage ratio is usually it's a look back or a backward looking ratio. So it will aggregate CFADS and the corresponding debt service for a designated period before the date which the debt service coverage ratio is calculated for. We will look at how to calculate that backward looking ratio in the complex financial modeling case study. So now debt amortization. So what happens, particularly in these greenfield projects, I mean it happens in brownfield projects as well, but let's think of a greenfield project where we've got a construction phase and then an operations phase. So during the construction phase, you are financing the project through mainly debt and equity, and I mean you can use other instruments, but debt and equity are the primary instruments. So we get to the end of the construction phase, and then at that point, think of a toll road. We start to get traffic through and we start to get tolls being paid. So at that point in time, usually we start to repay our debt. Now, a debt amortization profile using a credit foncier, or debt amortization using a credit foncier profile, keeps all debt payments constant over the life of the loan. One good way to think about a credit foncier, I know it's a fancy name, but it is basically a house loan, right? So think of a house loan. You usually pay a fixed amount each month, so the debt repayments are constant. Now, these are split between paying down your principal on your house or your amortization amount, and your interest. So what happens in a credit foncier repayment profile? Because the principal balance is high at the very start, usually you're going to pay a lot more interest. But as you pay down your house, what will happen is that principal balance will go down and your interest will start to decrease and you'll start paying more principal payments. And once again, the repayment profile is always contained in the debt documents. Usually what happens, particularly if you're a financial advisor, is you will actually insert the repayment profile into the facilities agreement or credit agreement. But at the end of the day, once that's inserted into the facilities agreement or credit agreement, then that will be your repayment profile based on how much you draw down. We've looked at the credit foncier repayment profile. We're going to use credit foncier repayment profile in the complex financial model in one of the tranches of debt that we put in. So we'll learn a lot more about that a bit later. Now, the second way we can amortize debt is through sculpting. Okay, so remember we touched on what CFADS and debt service coverage ratio is before. Remember we said, okay, debt service coverage ratio equals CFADS divided by debt service. Now, what happens if we've got a target debt service coverage ratio and we know our CFADS, can we find the debt service or the target debt service that we want? And the answer is yes. All you have to do is simply rearrange this debt service coverage ratio calculation. So instead of debt service coverage ratio equals CFADS divided by debt service, what we'd have is debt service equals CFADS divided by debt service coverage ratio. Okay, so just rearranging that formula. So if we go back to here, we've got a simple example where it says, okay, here is our CFADS. We know our target debt service coverage ratio. So now we're going to divide our CFADS divided by our target debt service coverage ratio. And we're going to find the target debt service. Okay, so remember what we said, debt service, in most cases, it's simply your interest plus your amortization or principal repayment. So in this case, if we've got a target debt service of 20, and we know that our interest payment is $15 in period 1, what we can do is, and I'll highlight this for you guys. Okay, what we can do, so we've got $20 of target debt service coverage ratio. We will know what our interest payment is. We know it's $15, so that means that we have $5 left to meet the target debt service, so we can put that towards our sculpted amortization. Similarly, with period 2, we can find our target debt service, less our interest, and then find the sculpted amortization by going target debt service less interest. Okay, and the final comment we've got on this slide is sculpted repayments are usually used in infrastructure projects as CFADs, so our cash flow available for debt service usually grows over time. This is not always the case. Sometimes you have, I know in sewage treatment plants, I've seen projects where your revenue grows at the same rate as your expenses. So what happens there is your CFADS is relatively constant along the way. So that would suit a credit foncier repayment profile because your CFADS is flat, so your repayment should be pretty flat. But in a lot of cases, your CFADS is going to grow over time. So in that case, what you can do, and we've got a blog tutorial out now on debt sculpting and how the credit foncier repayment profile works. But what you'll see in that tutorial is that with sculpting, you can put debt repayments towards the back end as your CFADS grows. So This matches your debt repayments with your CFADs, and that means that you can put more debt into the project. In most cases, this is going to decrease your cost of capital and mean that you can bid at a lower toll, etc., etc. Okay. Okay, so we'll briefly talk about this concept of debt service reserve account. So a debt service reserve account, it can be thought of as a cash reserve buffer for debt providers if a project has any cash shortfalls. An example of how a debt service reserve account works is shown below. The debt service reserve account is usually a forward-looking. So usually what it'll say in the loan documentation is that you need forward-looking 6 months of debt service for your debt service reserve account. So if we aggregate the debt service, so remember that is your interest and principal in most cases, it can sometimes include other fees like agency fees, etc., etc. As always, debt service is going to be defined in your project loan documentation. So what we can do is we can find, if we aggregate that debt service, we can find what our debt service reserve account should be in period 1, for example. So what we would do is we'd add up period 2 and 3. So here we're looking at a 2-period debt service reserve account, or a forward-looking 2-period debt service reserve account, and we're going to add the 20 and the 25 together to find our debt service reserve account amount. Same with period 2. So in this case, we're going to add period 3 and 4. So 25 plus 30 is obviously equal to 55 if I've done my maths correctly. Okay. And we're going to build in a debt service reserve account in the complex financial model. So we'll learn a lot more about how to calculate this in the financial model. Now we're going to look at some key modeling concepts. So in these key modeling concepts, we're going to touch on things that quite often we see people doing incorrectly, or not incorrectly, but it makes your life a lot harder if you don't follow these best practice modeling rules. The first thing we're going to talk about is the dates. So alignment of dates tends to eliminate errors across sheets. Okay, so what do we mean by alignment of dates? And we'll do this example in real time as well. But you can see that we've got 2 Excel worksheets here. So the first is Excel worksheet 1. So we've got a period ending, and in column G we have 30th of June 2010. So I'll just highlight this for you. Okay, right, and then we have it going up in 6 monthly intervals. So the next one's 31st of December 2010. Now what we have in Excel worksheet 2 is in that column G, we're going to have exactly the same period as we had in Excel worksheet 1. Okay, so when you're saying equal to a row, this is going to make it very simple. They're just going to pick up the column G and say, okay, this Excel worksheet 2 is going to be equal to the period ending row for Excel worksheet 1. Okay, so cell columns are aligned in each worksheet. Now, what if, say for example, let's look at column I this time, we've got in worksheet 1 we've got 30th of June 2011. Now in worksheet 2, in the same column, we've got 31 of December 2010. So although you can get things right doing this methodology, it's not best practice by any means, and it's going to make your life a lot tougher if you do it this way. So in this one, cell columns are not aligned in each worksheet. Okay, this is very prone to mistakes. So let's go and let's just take a look at an example. Okay, so this is our worksheet 1. So here we've got 30th of June. So we're going to call this date alignment. And we've got 30th of June, I think it was 2010. I'm just going to use the EO month formula. Don't worry about this. You're not following this in real time. Just listen to what we're saying. Okay, and I think that it was actually 6-month periods. Okay, so that should be right now. So that's worksheet 1. So period ending. Okay, so worksheet 2. Now, okay, so BD, so equals 30th of June. What we can do is let's just go and reference this one. So these are all aligned, right? So, okay, date, and we can even copy across the label as well. Okay, so this is the correct way of doing this. And we can even go equals, and we can select the whole row here. So you can left click, or I've just used shift spacebar to select that whole row, and then you can copy that one across. All right, so that is the correct way of doing it, or the best practice way of doing it. Now, say for example, we had a revenue here. Okay, so revenue 50 equals that plus 5. Okay, so what could we do in sheet 2? We could just copy this one down. So all I'm doing is shift arrow down and control D. And now I'm just going to control R that one across, and look, our revenues line up exactly. So that should be exactly the same as what we had on sheet 1. Okay, now let's say for example, I'm going to put a period ending, so equals period ending. Okay, that's fine. But now imagine that I had, and let's just look back at this example. So in column, or one column ahead of this one, we're going to have, okay, so that's what we're going to have similarly. Now we can change this one so that aligns properly with the example. And so now that will automatically update. Let's just change that. Okay, so that should line up with the example G. Yep. So we've done that correctly on sheet 2. Now let's just... So now what you're going to have to do is you're going to have to go pick out the revenue corresponding to that period if you don't have the cells aligned. That's prone to mistakes. What often happens is people will go and they'll reference the whole row or something like that, and they're going to get something that's wrong. So see here, we've got 30th of June 2010 and we've got 55, which is incorrect. Okay, so date alignment is critical. I'm just going to delete this now. But particularly when you're using named ranges as well, which we'll come to in a second. So let's look at names now. So we just talked about alignment of dates. Now we're talking about the naming of cells and ranges. And this makes models easier for you and internal and external parties such as peers and auditors. You can imagine that, okay, we've got an inflation assumption on our assumptions worksheet. It's 3%. Now we want to put something on our operations sheet. Now, of course, we can refer back to that cell in column G and say, okay, it's equal to G33 of the assumptions worksheet, yeah? But what does G33 of the assumptions worksheet really mean? If it says something like it's the inf, then someone could presume that it's an inflation, and if it's linking to an inflation row or an inflation index, then someone can assume that, okay, you're actually linking back to inflation on the assumption sheet. It makes much more sense when you're going through a calculation. Let's look at how we can name cells firstly. We've got, okay, copy, paste, naming cells. And what we're going to do here is we're going to do the inflation. Okay, and I think we'll keep it the same. So let's go inf here. I'm going to color that red. That's what we're going to be doing in the case study a bit later. So let's go, and that's 3%. Okay, so percentage, I'm going to color that blue as well. Now, in order to name a cell, I can do it a number of different ways. The first way, and the way I'm going to teach you right now, is just the Control F3 button. Okay, we're going to talk about the other ways when we get to the case study. Now we're going to go, you can use your mouse to go up to new, but you can also push Alt N. There's a line underneath the N, so when you see a line, you can usually push Alt N, so Alt N, so hold down the Alt and then N. And now see that I've got the inf on the left of the 3%, or the inf label on the left of the 3%, and it automatically comes up as the name. And what I can do is I can push enter there, then it's automatically entered here, and then I can push escape. And what you'll see, and I'm just going to put on the formula bar, so it's popped off for the moment. So let's go to advance. Okay, show formula bar, and okay. And as you can see, up in this top left hand corner, we've got inf. So it's actually named now. Any other cell would be just a column and a row. So for example, this is H35, but now our cell is named. And what we can do now is we can go and let's just look back, and we can put in inflation, and I think it's cell G, so we can go equals. We can simply type in inf if we want. So let's put that as a percentage. I'm just using some of our shortcuts from our shortcuts training tutorial, but don't worry about that if you don't have those shortcuts. Okay, and now we've got an inflation amount for each of these periods, right? So this could be period 1, 2, etc., etc. Okay, so that's quite simple. Now if we look at the formula, it is an inflation row, but sometimes you can get more complex formulas, and it says inf. That refers to the inf. So that's pretty simple. Now let's look at naming a row. If we're looking at naming a row, I can't emphasize enough that if you're naming a row, you must have your periods aligned on each sheet. Okay, so back to what we were talking about before with date alignment, you must have your periods aligned. So like we see in Excel worksheet 1 and 2, or the top two tables there, and that is best practice, and that's why we do that, and that's why we teach that in this video financial modeling course. Naming a row continued. Okay, so let's go and let's name something. So naming cells, now we're going to name a range. Okay, now we're going to put in revenue, and it's 50, 100, 125. So I think it was starting 50, 100, 125, and 150. Okay, now we will strategically place our revenue name when we're doing the case study, but for the moment we can just put it in D. I'm going to color that red again, And it's easier if you're on that label. So that label revenue, if you push Shift Spacebar and then Control F3, Alt N, and then enter, that thing's going to be named. So now if we go, we can select that revenue and that'll be named up in the top left hand corner. Okay, so now what can we do with that? So now what we can do is we can go equals, now it's revenue, let's just push F3 and you can see that that rev comes up now. So rev, copy, paste. Now let's paste it all the way along. And now let's just check the alignment here. So now what we're going to get is, okay, our revenue in J is 150 and our revenue in the equivalent column on sheet 2 is 150 as well. Now, how easy is that as well? If we look at that formula, it says rev. So, I mean, obviously it's going to probably be revenue. We can always look at it as well. So we can go Control open square bracket to go back to the revenue. And then we can flick between the two by going F5 enter and F5 enter, F5 enter. So you can flick between the two if you're auditing or similar.